Your government is in debt, not a little bit in debt. $36 trillion in debt, a number so large that if you spent $1 million every single day, it would take you 98,000 years to spend it all. This is real money, owed to real people, with real interest being paid every single second. And whether you know it or not, this debt has been shaping your life since the day you were born. What is national debt? When a government spends more money in a year than it collects in taxes, it runs a deficit. To cover that deficit, the government borrows money. It does this by issuing bonds, essentially certificates that say, "Give us money now, and we will pay you back with interest later." Every year that spending exceeds tax collection, the government issues more bonds. The total of all bonds ever issued that have not yet been repaid, that is the national debt. Think of it this way. Your household has income and expenses. If you spend more than you earn every month, you go deeper into debt each month. The total you owe across all your credit cards, loans, and borrowing is your personal debt. National debt works the same way, just with significantly more zeros. The United States currently holds the largest national debt in human history, over $36 trillion as of 2026. But debt alone does not tell the full story. How did it get this big? National debt does not grow by accident. It grows by decision. Every time a government cuts taxes without cutting spending, debt grows. Every time a government increases spending without raising taxes, debt grows. And every time debt grows, interest payments grow with it. And interest payments mean even more borrowing is needed just to pay the interest. The United States has run a deficit in almost every single year since 1970. More than 50 consecutive years of spending more than it collects. The biggest single jumps in debt came at specific moments. The 2001 tax cuts and military spending after September 11th added trillions. The 2008 financial crisis and the bailouts that followed added several more. The 2017 tax cuts added approximately $2 trillion over a decade. The 2020 pandemic response was the single largest single-year increase in modern history, adding nearly $4 trillion in 12 months. Each of these decisions made sense, or appeared to at the time it was made, but each one left the next generation inheriting a larger bill. Who does the government owe this money to? Most people imagine national debt as money owed to a foreign enemy, China, perhaps patiently waiting to foreclose on American land. The reality is more complicated and more interesting. Approximately 77% of the U.S. national debt is owed to domestic holders. The Federal Reserve, the U.S. central bank, holds approximately 20% of total U.S. debt. The government essentially owes money to its own central bank. Social Security and other government trust funds hold approximately 20%. The government owes money to its own pension funds, money that future retirees are counting on. American banks, pension funds, mutual funds, and individual investors hold the remaining domestic share. When you invest in a U.S. government bond fund inside your pension, you are one of the creditors. Foreign governments and investors hold approximately 23% of the total. Japan and China are the two largest foreign holders, each owning approximately $1 trillion in U.S. debt. This is why a U.S. debt crisis would not be a simple bilateral conflict between America and China. It would be a crisis that would damage every institution, pension fund, and investor on Earth that holds U.S. government bonds. What is the debt ceiling? The United States has a legal limit on how much debt the government can carry, called the debt ceiling. In theory, this is a constraint, a limit designed to force fiscal responsibility. In practice, the debt ceiling has been raised over 100 times since it was first established in 1917. It has never actually stopped debt from growing. It has only created recurring crises where politicians argue about raising it and then raise it. These debt ceiling standoffs have caused genuine damage. In 2011, the standoff caused the United States credit rating to be downgraded for the first time in history, a downgrade that increased the cost of borrowing and cost taxpayers billions. In 2023, another standoff came within days of the United States technically defaulting on its obligations for the first time ever. In 2026, the debt ceiling is once again the subject of intense political negotiation. The debt ceiling debate is real. The consequences of crossing it are real, and the pattern of raising it and moving on has been repeated without exception. Does national debt actually matter? This is where economists disagree more than almost any other question in their entire field. The traditional view is yes, debt matters. Large debt means large interest payments. Interest payments that consume money that could be spent on schools, hospitals, infrastructure, or tax cuts. In 2026, interest payments on the U.S. national debt are approximately $1 trillion per year, more than the entire U.S. defense budget. Debt also constrains future flexibility. When the next crisis arrives, whether recession, pandemic, or war, a government already carrying enormous debt has less capacity to borrow and spend its way out. The more modern view associated with modern monetary theory argues that a government which prints its own currency can never truly run out of money, that deficits and debt are less dangerous than traditionally believed, that the real constraint is inflation, not the debt number itself. The truth is almost certainly somewhere between these positions. Very high debt levels do eventually create real problems, but the relationship between debt levels and economic damage is not simple or immediate. What most economists do agree on is this: debt that grows faster than the economy grows is unsustainable in the long run. And in the United States, debt has been growing faster than the economy for the majority of the last 20 years. What happens if a country cannot pay? Most countries that default on their debt are not wealthy superpowers. They are emerging market economies that borrowed in foreign currencies they cannot print. Argentina has defaulted 9 times in its history. Each default caused severe economic pain, currency collapse, inflation explosions, unemployment spikes, and years of isolation from international credit markets. Greece in 2010 came close to defaulting on its euro-denominated debt. The EU and IMF bailout that followed came with severe austerity conditions, spending cuts, tax rises, pension reductions that caused significant human suffering for the Greek population for nearly a decade. The United States is different in one critical way. It borrows in its own currency, the dollar, and the dollar is the world's reserve currency, used in approximately half of all global trade and held as reserves by central banks around the world. This gives the United States an extraordinary privilege. It can always print more dollars to pay its obligations. The risk is not default, it is inflation. Printing dollars to pay debt devalues the currency and redistributes wealth from savers to debtors, which is exactly the inflation mechanism we discussed in the inflation video. How does national debt affect your life? Even if you never buy a government bond, national debt affects your life in concrete ways. Interest payments crowd out other spending. $1 trillion per year in interest payments is $1 trillion not being spent on healthcare, education, infrastructure, or defense. It is a direct reduction in the services your taxes could buy. Higher interest rates. When government debt is large and growing, bond markets eventually demand higher interest rates to continue lending. Higher government borrowing rates pull all other interest rates upward: mortgages, car loans, business loans, credit cards. Your borrowing costs are partially a function of government debt levels. Inflation risk. As discussed, the alternative to default is inflation. If the government ultimately monetizes its debt through money printing, the cost is paid by everyone through the reduced purchasing power of their savings and wages. Generational transfer. National debt is, in a meaningful sense, a bill being sent to future generations. The spending happens today. The repayment obligation falls on people who were not yet born when the spending decision was made. You are currently paying interest on decisions made decades before you could vote. Currency risk. If confidence in the dollar as the world's reserve currency were to decline, the adjustment would be severe. The dollar's reserve status gives the United States enormous borrowing privileges. A world that trusts the dollar less is a world in which America's debt costs rise dramatically. Is there any way out? There are 4 theoretical ways a government can reduce its debt burden. The first is growth. If the economy grows faster than the debt grows, the debt becomes smaller as a proportion of GDP over time. This is the preferred solution and the one that works best historically. The U.S. debt to GDP ratio actually fell dramatically in the decades after World War II, not because debt was paid off, but because the economy grew enormously. The second is austerity, cutting spending and raising taxes to run surpluses, paying debt down directly. This works mathematically, but it is politically painful and economically controversial. Austerity during recessions typically makes the recessions worse. The third is inflation, deliberately or accidentally allowing inflation to reduce the real value of the debt. As prices rise and wages rise, the fixed debt becomes smaller in real terms. This is a hidden tax on savers and a hidden benefit to debtors. The fourth is default or restructuring, refusing to pay or negotiating reduced payments. This path is catastrophic for credit ratings, currency values, and economic relationships. It is not a realistic option for the United States under current circumstances. The honest answer is that no single solution is sufficient. A combination of growth, modest fiscal restraint, and accepting some inflation is the most likely path forward. The debt is real, the choices are difficult, and the consequences of avoiding those choices fall as they always do on ordinary people. Let us bring everything together. National debt is the total accumulated borrowing of a government, the sum of every deficit ever run that has not been repaid. The United States carries over $36 trillion in national debt, the largest in history, owed primarily to domestic institutions, pension funds, and investors rather than foreign enemies. Debt grew through decades of tax cuts, spending increases, crises, and bailouts. The debt ceiling has never actually constrained it. Whether debt matters is genuinely debated, but debt growing faster than the economy is a long-run problem. Default is not the immediate risk. Inflation is. National debt affects your life through crowded-out services, higher borrowing costs, inflation risk, and generational burden. The path forward requires growth, fiscal restraint, and honest choices that politicians have avoided making for decades. This is not financial advice. Please consult a qualified financial professional before making any investment decisions. Check out other Broke Monkey videos for more financial topics explained simply and clearly. If you want to support this channel so we can keep making these videos, check out the link below. Apes Together Strong.